Hi, I'm Patukura freefincal, and today let's talk about value investing. And what is value investing first? So, value investing, the definition itself is quite simple. You look out for stocks that are trading at a price lower than their intrinsic value and buy them in the hope that after you buy, they will move up and never go down and become multi baggers, or whenever you have money they will magically come down, and after you invest they'll go back up again. So that's the ideal definition of value investing. The problem is with defining what is the intrinsic value of a company. And again, just like many other things associated with the stock market, it's like many blind men touching the elephant, and each one has a different definition of the intrinsic value of the company, and therein lies the problem of value investing. Now, how do you define undervalued stock? Now, if you search for this, one of the first pages you'll get is the Wikipedia link of an undervalued stock. I'll talk about that later. That's got so much information that probably will save you something like $500 worth of books in that single page alone. But let's come to that later. So, to define an undervalued stock, assuming you can do it based on the balance sheet, based on numbers, based on quantitative measures, you can choose to follow a value index, the one also called a factor index or a smart beta index or whatever you want to call it. So these indices pick stocks, let's say from the Nifty 500. We have seen this index before in the ICSA value discovery and quantum long-term equity video. So this picks stocks from the Nifty 500 with low PE, low PB, low sales to low price to sales ratio and high dividend yield. And that kind of a robotic stock picking would lead to this kind of a performance. Over 3 years, notice the white line is the rolling returns, the 3-year rolling returns. There's something like 2,600 data points in each colored line, and the white line is the Nifty 500 value 50 index, and the Nifty 500 is green. Notice that the value index is a lot more volatile, and it doesn't beat the Nifty 500 often. There are extended periods where it does not beat, and it's extremely risky. So this is the problem of trying to be a value investor based on quantitative parameters alone, and that's the reason why I'm so scared about it. Because any stock picking method, if I say this is the stock picking method or this is the stock picking template which somebody should follow, that should be reproducible. Everybody who follows that should be able to get reasonable success, if not the same success, reasonable success. And that is not possible if you use a quantitative measure, because it's not going to be always successful, and compared to the base index it is significantly more volatile, and that's not a great idea, right? You don't want to choose a method that is by definition more risky. And the reason why that is more risky can be immediately seen if you compare the performance of the Nifty 500 value 50 index with respect to ICICI value discovery, which is the blue line, and quantum long-term equity. Both of them are value funds, and notice that they are able to beat the value index during certain times, and they have significantly lower volatility, and that's because of the qualitative assessment of value stocks that comes from a human fund manager involved. And this is the big problem with value investing and why it's not reproducible, because there is a qualitative assessment. And that brings us to that Wikipedia page. And I'm just astonished by that by the amount of information in this single page. It's not even a big page compared to other relative Wikipedia pages. So it talks about different value, what is a value stock, etc., etc. Give some information about about Charlie Munger, Warren Buffett, blah blah blah, Benjamin Graham, and so on. And the reason how I got to this page is because Morningstar has a equity that is a direct stock, direct equity tool by which it can tell you whether the stock is overvalued, undervalued, fairly valued, has got competitive moat, etc., etc., etc. That I wrote a post on this, but I think I'll tell you the reasons why I need to refurbish that post. The tool is still available, but it's not easily, I don't think it's easily available on the front end. The reason why I came upon this Wikipedia page is because I was looking for Morningstar's definition of of an undervalued stock. And that definition is very close to the NSE's definition. You can see that here. See, Morningstar uses 5 factors: price by prospective earnings, price by book, price by sales, price by cash flow, and dividend yield to check whether the stock is overvalued or undervalued. Now, coming to the that's the quantitative aspects. Coming to the qualitative factor, the paragraph below is absolute gold. Warren Buffett says that the value of the business is the sum of the cash flows over the life of the business discounted at appropriate interest rate. This is a very loose statement, and this is being interpreted by Warren Buffett is also an elephant, and there are many experts like blind people touching his works and interpreting it. The probably the most easiest, maybe even wrong interpretation of this is to use a discounted cash flow technique. There's a method called discounted cash flow method to value stocks. In my stock valuation tool, that's one of the techniques. There's a DCF, there's a reverse DCF, blah blah blah, and so on. No, essentially what it means is, if I want to check whether a company is overvalued or undervalued, I must look at its future. I must ask, okay, the price is attractive, but will this, if I buy it, am I guaranteed that the price will move up? Because will the company do well in future? I mean, will it be able to handle the competition? Will technology, will it have problems because of technological advances? Will it be able to survive? Will it do well in a recession? Blah blah blah. And those kind of qualitative, that's the assessment that WB is talking about. But again, these kind of assessments cannot be done using numbers, because when you do a cash flow analysis, you have to put in certain projections, certain growth rates, etc., or interest rate, discounting factors, and so on and so on. And it's just, it's anybody's guess what those would be. You can choose conservative numbers and so on, and it's very that's all very easy to say, but that doesn't mean you're going to get it right. And that's the biggest problem. Why it is so difficult to reproduce his technique, and it's a intuitive going by your nose thing, and most people don't have a nose for such things. So this is the big problem. So you can learn more about discounted cash flow methods and so on, but it is not clear whether that is exactly what he means, because Charlie Munger says he has never seen Warren Buffett use it. So there are disputes on that and so on. So that's so you can talk all under. Now this is a very nice checklist of whether a stock is undervalued. So it says for a stock to be called properly undervalued, or to be called a value stock rather, the company's earning history should be stable. The company should not specialize in high technology that could become obsolete overnight. I don't know where this is sourced from. You can check it, but it's all available for free in Wikipedia, and it makes a lot of sense. It should not have any kind of financial scandals. There should not be decline in profitability, blah blah blah, and so on. The debt should be low. It should not have made a loss during the last recession, and so on. So these are the kind of factors. It also you also have to look at the peer group of the company and make a call. So it's not simple. Just look at its PE and dividend yield and so on and make a call. So that's the big problem associated with value investing. But that's a very nice list. If you still want to become a value investor, that's a very nice list. I don't know where it's sourced from. I don't personally care. But that Wikipedia page, like I said, it's amazing. It's got so much information. Every sentence is a gem. And even here, an excellent stock at a fair price is more likely to be undervalued than a poor stock at a low price, according to Charles Munger. So it's every word in that article, if you it makes you want to think and learn. So that brings us to the risk associated with value investing. So you must have heard this phrase called value trap. When you buy a stock which is supposedly trading at a low price, or for most people, value buy means it is trading at a price that they can afford, and that's terrible. So you don't know whether it's a value buy or a value drop, meaning that you don't know whether it's going to pick up soon enough. Because I mean, if the market has decided that stock has price has to be low, then I mean, um, how long can it be low? Because if that stock is really good, if the intrinsics of that stock is really good, why would the market keep it at such a low price for such a long time? Collectively, because of the randomness, whatever you want to call it, sooner or later, sooner I would say, the stock will move up. And therefore, this is the big problem with value investing, because when you buy, it's very difficult for you to say it's going to be a value buy or a value drop. Also, the stock may pick up, but it could pick up after 1 year, after 2 years, you don't know. Then there's a time lost. When you lose time, you lose returns because of the time value of money. So the risk associated with waiting for a stock is extremely important, and that has to be factored in when you do value investing. I think not many people are paying enough importance to it, because time value of money is crucial in all these things, and that's the big problem associated with value investing. It's a lot more riskier than the market. That is the reason why I prefer low volatility investing, because it's simpler, it's reproducible, and it has got market support. Because a stock which tends to move up with low volatility means the market has got the general market is supporting it, and there's a nice index available, and it's easy to find out low volatility stocks on your own, and it's a lot more simpler to buy low volatile stocks which are trading at a high price, admittedly, but has this general support of the market, rather than buy a stock which the market has for some reason temporarily, or because of a general market fall, or for a specific reason rejected it, and you think it's a value buy. For example, many people think S Bank is a value buy. For God's sakes, it's probably just the opposite. I mean, so don't tell me about quantum long-term equity. I don't know that. I have not looked. So this is the Nifty low volatility 50, the black line, and you see the 10-year rolling returns with respect to Nifty 500. Notice that it has done extremely well. You have guaranteed low risk because of definition of low volatility, and you get good returns. If not, at least Nifty 500 returns, maybe if you're lucky, more. And that's a very good deal in my opinion, compared to making a risky judgment and buying a so-called value stock. So there is a way in which you can avoid value traps. That's by using a combination of value and momentum. So momentum is basically looking at the last 6 months price movement, or the last 1 year price movement, and looking at how much it has moved up. Higher it has moved up, higher the momentum. And but if you look at that, if you combine value ideas, that is low PE, low PB, high dividend yield, etc., along with momentum, and then you can, when the market realizes that this is a value pick, then it will become a momentum stock, and therefore when it moves up, you can buy that stock. You can buy a value stock that's tending to move up. Instead of buying a value stock that is down, you can buy a value stock that is tending to move up, and the risk becomes lower because you can get a higher return. You can see the white line is the S&P 500 high momentum value index, momentum plus value index, that is bet or is comparable to the momentum index, the yellow line, and both the momentum and the momentum value indices have comfortably bet the blue line, which is just the value index. So that's the reason why I like momentum investing as well. Momentum investing is closely related to low volatility investing, although it's a lot more riskier because of the churn. In momentum, you are looking at volatility in the price movements in a slightly different way than in the low volatility index, where you're looking at the standard deviation of the price movements. But there is a close connect, in my opinion. Of course, it has to be quantitatively argued. I don't do that kind of research. I don't have any motivation to do it, rather. But I'm sure other people should take it up. So a direct equity value investor, or a person who is investing in value funds as well, should understand that when they look at a stock and when they see it's attractively priced, they should ask themselves, why has the market sort of rejected the stock in a sense, or have not priced the stock at a fair value, why is that stock trading at a value lower than its so-called intrinsic value, or low, whatever you want to call it? And people, they should have a quantitative feel for the future of the business and whether the business has a good future or not. This is not at all easy to do. It is possible, but not everybody can do it. That's the problem. And they cannot wait too long for the value buy to recover. It will be disastrous for their portfolio returns. And ruthlessly, they should be able to sell a bat. If they make a mistake about a value buy, the stock does not go up, chuck it and move on to something else. Otherwise, time value of money will erode the returns. Nobody is going to give us awards for following Warren Buffett or becoming a value investor. It's fashionable to say I am a value investor. Nobody gives a shit. People want returns, and that's the only reason they invest. And that is the reason why I believe it's easier, reproducible to buy low volatility stocks. You can have a peace of mind and good returns. That's enough. I don't want stellar returns, but good returns, good enough returns. So that's what I wanted to say. If you have any comments, please leave them below.